Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from equities to FX to bonds. For our latest views, visit macrohive.com. Before I start my conversation, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up for our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com/free. All of these make a big difference to me and make the effort of putting these podcasts together well worth the time. Finally, and my third request is that if you're a professional or institutional investor, do get in touch with me. We have a very high-octane research and analytics offering that includes access to our world-class research team, our model portfolio and trade ideas, machine learning models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details.
Hey, Rory, and welcome back to the MacroHive podcast.
Thanks for having me, man.
So I was reviewing the discussion we had with you last year, and you made a couple of big calls, notably one of them that Brent will average $65 a barrel in 2025, which actually worked out very well. So no pressure for today's call. So with that said, before we go into what worked right, why don't you just talk about what were the key drivers of the oil price this year as you saw it, and what actually caused the price to decline?
Yeah, so I think as we discussed, last year, and I think as anyone that's been following the oil market has had it beaten into their head by now, we're in a surplus supply situation. And I think that's the simplest way to describe it. So what's been putting downward pressure on oil prices and term structure and kind of everything across the barrel has been the fact that last year supply grew by something like 3 times as fast as global demand did, at least through the second half of the year as OPEC Plus kind of really ramped up its accelerated production hike increases. So by the end of the year on year, growth in supply was, by my numbers, about 3 times the pace of year-on-year demand growth. That left for any period of time is inevitably going to cause a glut, and we've already started to see visible kind of OECD inventories building, albeit not as quickly, and this is where we get into the interesting parts of what happened last year, not as quickly as those kind of headline surpluses would indicate. And I think the one thing that there's 2 things that caught the market off guard, particularly in terms of the scale. I think these are things we're used to dealing with, but the scale with which we had to deal with them, I think, was kind of fairly novel. The first one, I think, a little bit more simply, is what's been happening with Chinese strategic reserve buying. Now, that wasn't a consistent theme through the entirety of last year. There were moments where they were selling as well, but on net, they built something like 100 million plus barrels over the course of the year. And at various points during the year, we're building their SPR. So essentially, what we would consider the excess demand really from China at more than 1 million barrels a day through various periods.
Just to interrupt you there briefly, could you contextualize us? So how big is 1 million barrels a day build, and how does that maybe compare to, the emptying of the SPR that we saw by the US in 2022?
Yeah, I think it's a really good point of comparison. So just in terms of rough numbers, we're talking about a market that we're still rounding to around 100 million barrels a day of supply and demand. I think we're probably up around 105 on each now, but give or take, easy to still round. So let's say 1 or just less than 1% of global supply. And relative to the pace of what we saw from the US SPR in 2022, when the Biden administration really wrenched down the reserve, it was drawing down at its peak at just more than 1 million barrels a day. So this is, for most of last year, we saw China building its SPR faster than the Biden administration was drawing down the SPR at its absolute peak. So these are very, very big numbers. And again, to put that 1 million barrel a day in context, I think a lot of people are like, oh, well, less than 1%, that's nothing. When we see the market in kind of protracted supply or demand, a supply surplus or deficit, like let's say 2016, when we had this massive surplus that drove at that point WTI down to at that stage kind of an unbelievable kind of $26 a barrel at its low point. That was only a surplus of around 1 to 2 million barrels a day sustained for a long time. So as you can see, it doesn't take a lot of surplus to drive this market completely off the edge of a cliff. So this million barrels a day of consumption or additional import for China to fill its SPR was essentially a million barrels a day of additional demand. And I think that's the other thing that's important to parse here is that I think for a lot of people, they think inventory builds are bearish. And I think that's true in a sense. If you have a bunch of supply and a bunch of demand, and there's more supply than demand, you need these, the inventory capacity to essentially catch these residual barrels from like completely killing the market. That kind of inventory build is bearish. But when you see China kind of stepping in, and if we think about like the order of causality or the order of kind of pricing influence, China steps in before that residual stage to buy those SPR. So it's actually a demand for SPR building rather than as just a residual kind of Chinese SPRs built because of the glut. So I think that's an important differentiation. And one of those things that, again, China has built its SPR for years, but just the pace at which it did this was kind of surprising and really put the brakes on, how negative that pricing and that surplus, that effect was having on the oil price. Now people ask, like, how long can this go for? And the answer is like a really long time. Like most of, the statistics, there are no official Chinese inventory statistics. So you're kind of using various providers, satellite inventory analysis, et cetera. But most of those show that even including this massive swell of inventory, Chinese storage tanks are probably only maybe 2/3 full. They could build at a million barrels a day. They could probably build for that pace for another 2-3 years straight. Now they probably won't. And I think that's where this becomes interesting. It's like, what is China actually trying to do here? Is it trying to insulate itself from an energy security angle? I think a lot of people are talking about like, maybe this is what they would do ahead of an invasion of Taiwan or something like that, that we've seen. China has built lots of strategic reserves of lots of commodities, not just oil. So that's one element. Or maybe it's just because the price is low. But I think there's also an inherent kind of conflict in that narrative, because if China didn't buy those SPR barrels, the price would have gone lower and they could have got a better deal. So there's a lot of these questions that I still think no one has really, really good answers for. All we know for sure is that Beijing directed a lot of these state-owned oil producers in particular to build reserves, or what they would call commercial strategic reserves, which itself is kind of an oxymoron. But at the same time, they're building more storage tanks. So there's lots of ammo left in kind of Beijing's SPR demand clip, if you will. And that's going to be this question going forward. And I think you already saw this through mid last year, that essentially now people like sell side shops will have their headline supply demand balance, and then they'll have like a memo item for like an assumption of how much China kind of hoovers up that kind of excess. So if you have a 2 million barrel a day surplus and China hoovers up 1 million barrels a day, well, you're only left with a functional million barrel a day surplus, and that remainder is what's actually going to weigh on the market. I think that's going to be a useful kind of reference point or kind of line item we're all going to need in our models going forward for at least the next couple of years.
Great, thank you. That's really helpful conversation context. So you talked about, the main reason prices are lower is because we're in the surplus. Now, driving this surplus was this shock and awe announcement by OPEC Plus in April, which sort of coincided with Trump's tariffs. Can you talk a bit more about, the scale of increase in supply from OPEC Plus, and then why do you think they did it at that time, just as tariffs were coming on?
Yeah, and I think the other thing I'm just going to mention that we're going to come back to is that the other element that kind of stopped this kind of surplus from really killing the market overall was all of Trump's sanction activity that we'll get back to. But I think that kind of dovetails to the tail end of what's happening with OPEC. So I think OPEC last year, they unwound not just their third kind of voluntary production cut tranche, but also began unwinding the second one, their kind of first voluntary tranche as well. In total last year, OPEC Plus unwound roughly 2.9 million barrels a day of supply cuts that were on the books in various ways. That's a staggering amount of crude in any year. Not to mention, it only actually was dumped on the market between April and December. So it's only, it's actually 2/3 of a year, and you dumped basically 2 or 3 times normal annual demand growth back into the market. So OPEC had to know, and OPEC did know, that this was going to have a tremendously negative effect on prices. I think to some degree, they have been pleasantly surprised the degree to which it has not had more of an impact on prices because of Chinese inventory building, because of the sanction stuff we're going to talk about in a second. All of this essentially prevented that production from becoming realized supply that had to kind of compete and kind of pull down those prices and fill commercial inventories. So the question of like why OPEC did this is something that I still think is legitimately debated because no one truly knows the mind of OPEC leadership or the Saudi royal family or whomever. But I think there's a couple kind of high contenders. So the first question, I think the first most obvious one is that what they were doing, what OPEC Plus was doing by, on paper, cutting roughly 6 million barrels a day of production from the market and holding it like that, what was initially supposed to be a temporary production cut, they held on to for years and years and years. So at the baseline, it was unsustainable. Everyone in the market knew it. OPEC knew it. So at a baseline, it had to be unwound at some point, right? So I think we shouldn't be shocked that it got unwound. But I think it was relatively shocking, not just that they unwound it, but that they unwound it and then tripled and quadrupled and quintupled the pace of that unwind in a very kind of like rip the Band-Aid off and get this all done. So I think some of the factors, and when you started the year, OPEC, when you started 2025, I should say, OPEC was still honestly in this process of like perpetually delaying. They had said they were going to start the increased production. They're like, maybe next month. We'll get another couple of months. The conditions aren't quite right yet. And then all of a sudden, in March for April, they were like, no, we're actually going to do it this time. And they did their first hike of like 137,000 barrels a day. Pretty small potatoes in the scheme of things. But what drove that trigger, I think, one of the things that kind of became unignorable was Kazakhstan in particular. So Kazakhstan went from generally kind of being within the realm of production quota to overwhelmingly, and every single person knew it, overproducing by 400,000 barrels a day. And this is basically because the Chevron-led Tengiz expansion came online at the beginning of 2025, and that essentially pushed them well beyond their normal quota. Now, the thing to keep in mind here is that this expansion had been worked on for a decade. Like everyone knew this was coming. It was in everyone's models. It was in OPEC's own kind of assumptions, if they were being honest about it. So like, why? And I think there's this moment where what we've seen from OPEC over the past couple of years is a little bit of this, like, we're just going to pretend the bad things aren't happening until we have to deal with them. Because dwelling on this stuff when maybe, this is the oil market, 80 bajillion things could happen, dwelling on the hard stuff ahead of time has a lot of political cost. And in many cases, maybe you don't even need to go along with what you were like negotiating. So, but regardless, Kazakhstan was really overproducing. You mix this with the fact that you needed to start unwinding this anyways. I also think while they were acknowledging Kazakhstan's overproduction, you also started to see, by my own kind of implied production numbers, slipping in terms of compliance from Kuwait, the Emiratis, Iraq, a bunch of these other members that OPEC's own numbers say they were still in compliance or roughly in compliance, but the slippage started with them as well at the beginning of 2025. Everyone was getting impatient. So at the end of the day, like, fine, we're going to start this. And then in April, you got Donald Trump's Liberation Day tariff announcement that kind of tanked oil prices, tanked global macro sentiment. And I think at that stage, OPEC panicked to a degree. They kind of looked at this and said, wow, we were already going to be looking down a pretty bearish environment. And now Trump, the president who I think going into this, the market's broadly expected to be growth stimulative. We saw that in his first term. It was like, oh, it's chaos, but it's really going to be good for the stock market. It's going to be good for global growth. It's going to be good for all this stuff. So in general, was going to be demand positive. All of a sudden, like, nope, this is not going to be a demand positive presidency, at least in the first year. Okay, what do we do? And what they decided is the day after the Liberation tariff announcement. So I think there was no mistaking that this is a purposeful driving the price lower. That was OPEC going from like, maybe we need to back away from an unsustainable strategy to, okay, this means war. And that's when they announced a tripling of the production hike for May. So that was, 411,000 barrels a day. That's when things got pretty serious pretty quickly. And that's when everyone started talking about this kind of insurmountable glut that the market was going to be facing into the second half of the year and particularly into 2026. That is when I think OPEC has already had this kind of like sentiment of like, you pretend you know, but you don't actually know. Like everyone's super confident. The IEA is super confident. But we're just going to kind of be like contrarians for the sake of like, we all hate global institutions now, right? That's kind of that's the politics of the day. So let's lean against the global institutions. They're overconfident. They couldn't possibly know. And look what happened. The surplus didn't have it had some negative effect on prices. I think we should be clear about that. Prices did fall quite considerably last year. Term structure went from strongly backwardated across the curve to this bizarre kind of smiley face shape that I'm sure we'll talk about more, about kind of this belief, this overwhelming consensus belief that the market was heading into surplus, but that surplus kept getting delayed by the Israel-Iran war in June. Then there were, sanctions on Rosneft and Lukoil that gummed things up. Then there were all the other sanctions. There was a blockade on Venezuela. All this stuff happened that essentially robbed that supply side. And I think there's truthfully a little bit of, I think, dishonest kind of celebration at the end here. Like, oh, look, they were wrong. It's like, well, no, none of those things were in the actual scenario assumptions. Let's be honest with that. And they can say, sure, the forecast was wrong, but it was not wrong. It was wrong for the right reasons. And I think that's important here. So now we can kind of say, like, look, if you assume that Venezuelan supply to the market was going to zero, and if you assumed that Kazakhstan supply to the market was functionally going to zero because of disruptions at the CPC terminal, and Russian supply to the market got nuked by like 500,000 barrels a day because of these backups on water, and all this stuff all added together. Yeah, suddenly there's no longer 2-3+ million barrels a day of supply surplus. There's actually pretty balanced. And I think that's the market we've been in for the past couple of months, is this market where everyone kind of knows that once things normalize, it's going to get bad and prices are going to get weak and we're going to build OECD commercial stocks and everything else. But at this stage, no one's really that confident that next month is the moment that we're all going to normalize, because we've been thinking this is going to happen for 6-7 months now, and each month there's something new. I think what we've seen, this is where we kind of get into like the theory of Donald Trump's presidency, which is I think a lot of people assume, and I think still firmly believe, that because Donald Trump loves to talk about why he wants oil prices lower, that he himself is a bearish factor for the oil market. And I would firmly argue at this point that over the last year at least, no idea what the next 3 years is going to bring, heaven help us, but at least over the first year, Donald Trump's presidency has been a ubiquitously, kind of overwhelmingly bullish factor for oil markets that have prevented all of those surpluses from hitting the tape and dragging us lower. So I think that's this function now is we've seen that Trump keeps getting more and more kind of emboldened by what he sees as successes in these kind of very splashy adventures, whether or not it's 14 bunker buster bombs on 3 Iranian nuclear sites, or it's a blockade and a kidnapping of the Venezuelan president, or now it's Greenland, or whatever else. Each one of these things emboldens him to reach more aggressively, and I think reduce his own kind of risk averseness, if that ever was a thing that he had. But I think eventually all this is saying is that we're going to keep getting more and more volatile until it blows up on him. And I think it's one of these things that we don't know when that is. It could be Greenland. Who knows? But at this stage, he keeps kind of getting what he wants because the United States has the most powerful military on the planet. He keeps using it as such. But eventually, the tale of overextended, overambitious empires is like as long as human history. Eventually, you get overconfident, you get cocky, and then something goes wrong. And it either gives you this spillover domestic political mess you need to deal with, or you can't handle it. And now like a quarter of the US Navy is sitting off the coast of Venezuela instead of in the Gulf where it might want to be for other reasons. There's all this stuff going on. And I think it's still difficult for us to kind of forecast the specific kind of idiosyncratic capriciousness of the current president.
Yeah, no, makes sense. So just, one of the things being in the oil market you find is there's conspiracy theories running wild almost at all times. One of the conspiracy theories that was quite prevalent around the Liberation Day time was that, President Trump made a deal with OPEC
Yeah.
members to increase production in exchange for perhaps advanced semiconductors, lower tariffs, or whatever the deal is. What is your view on, some sort of deal of that nature?
I think there's a couple ways of thinking about it because I think given the sheer volume of noise in the headlines, it's easy to find lots of little tidbits and breadcrumbs that support any given conspiracy theory in this environment. So it's easy to kind of say, of course, Donald Trump is the most powerful man on the planet. He, of course, has private kind of chats with all the leadership of OPEC and whatever else. And maybe it's like, oh, well, if you agree to increase production, then I'll agree to bomb Iran or, something else, right? I think there are a couple issues with that. And I'm not saying it's impossible because in this market, obviously anything's possible, but I would say it's not my base case assumption of how things went down. And I think there's a couple of reasons. Most simply, I do not think that Donald Trump as a person is capable of making a deal like that and then not bragging about it. I think we would have heard about some kind of secret deal with the Saudis, very frankly. I think that it's impossible for him not to kind of like brag about it. He would have demanded a Nobel Prize for it potentially. And I think the other issue here is, again, that there's this assumption of like, did Donald Trump mastermind some kind of capacity to free him to do all of this wild adventurous stuff? Or I think it's all a little bit kind of like happenstance. I think that OPEC had put itself into this issue, this kind of, we are holding 6 million barrels a day of paper cuts, and that can't go on forever. That was pre-existing Donald Trump, right? So that, that was already a fact of the market. So that needed to be unwound. Kazakhstan overproducing wasn't a factor of Donald Trump. I think more likely OPEC did what it was going to do based on its own best self-interest. And I think I can kind of backseat drive OPEC all day. I love doing it. But at the end of the day, they are trying to run a business and run multiple countries. They have to do what's best for them. And I think at this stage, anyone trusting that they can make a durable deal with Donald Trump in which they do not get burned is not a smart assumption in the current market. So I think they got to do what they got to do. But I think, was it in their mind that, like, by the way, Donald Trump asked us to do this from a stage in Davos in his first week in office? And is this going to make him happier with us? Yeah, I'm sure that entered into the calculus, but I do not think it was the primary driving factor. In the same way, I do not think that Donald Trump planned to bomb Iran and invade Venezuela, et cetera. And as part of that was like, aha, I'm going to get OPEC to increase supply proactively. Kind of, and this is, I think, we saw that attempt at this in another reason I think to think it's not this. So we saw this actually in 2018 when Donald Trump basically told the Saudis et al. That I'm going to attack Iran. This was actually all in the open. Everyone knew that this was a deal. Again, to the point that Donald Trump cannot keep a secret about a deal like this. OPEC increased production basically as a precaution to front run the losses of Iranian supply. And then at the last minute, Donald Trump rug pulled the entire situation and said, actually, I'm not going to bomb Iran. And that's how we got that massive like $25+ a barrel route in December of 2018 when all of this kind of rapidly unwound. So I think that was the last time that the Saudis made a deal with Donald Trump kind of proactively, and it didn't go great for them. So I think that in this moment, I think it's much more likely that Donald Trump happened into a situation of falling oil prices, surplus supply, weak oil markets, and it essentially was a birthday present for him. This was the best possible situation. Here's I think the more interesting question. Would Donald Trump have bombed Iran and invaded Venezuela if OPEC did not hike? And I think that's a much more interesting question because I think that one was going to happen regardless. And I don't know if Donald Trump, given that we know that he likes low oil prices, would have done something that would have so obviously stoked oil price. Like if we had lost 2-3 million barrels a day of supply because of all of this stuff in a tight market, we would be triple digit oil easily. easily in these kind of situations. But I just don't know if he would have had the appetite for that. We saw that even with his rapid walk back from Iran on reports that basically his advisors say, like, a lot of people were saying go for it. JD Vance was saying go for it. But the security assessment was like, if you do this, this could be a much longer, stickier quagmire than you're probably comfortable with. He's like, that doesn't seem worth it. Particularly because he also talks about Iran, he talks about what's happening in Venezuela as something that's going to reduce, he in his mind thinks that these things will reduce the price of oil.
Yeah.
Whereas so far, they have overwhelmingly stoked it.
Yeah, no, absolutely. So just to, that point well made. So to wrap up 2025, the other two big things, which one you alluded to, which is this large build of oil on water. If could you touch on that? And the second one is, how has demand looked this year? Because obviously there's been a lot of focus on supply, but we've also had tariffs go up in the US, and China's still been able to build 1 million barrels a day of oil. So how has demand looked this year relative to consensus?
Yeah, so let's start with the sanctioned and the oil and water stuff, because I think that just plays a little bit into the similar theme with the Chinese SPR building. Is so back to this point of like everything Donald Trump has done is actually bullish for prices. We see this because there's a bunch of different ways of handicapping what exactly or how effective these various sanctions regimes are on. Again, we'll talk about like the sanctioned three: Russia, Iran, and Venezuela. You can look at pricing. The larger the discounts, the more evidence of pressure from sanctions. But another one that, like the physical vector that's very obvious, is when you see massive builds of oil and water, which essentially is a reflection of things taking longer to get where they're going, traveling on less optimal, longer routes, things taking, ships lingering, waiting to clear customs or waiting to deal with financing or insurance or whatever. All of this just manifests as ships taking longer to get where they're going. And that manifests as higher oil and water. You can actually, to a degree, really almost just directly back out the effect this has on functional supply by looking at the incremental loss of supply in terms of oil and water builds. And for the latter half of last year, that was between 500 and 800,000 barrels a day that we steadily lost over the second half of the year just to builds of oil and water, which again goes, upwards of half or, upwards of almost half of that kind of supply, supposed supply surplus was just getting dumped on water. Now, one would assume that oil and water will come back down, right? Once sanctions are lifted, once, normal supply chains resume, like we would expect to happen with Venezuela now, that oil and water basically becomes basically almost like an SPR stock that basically starts dumping back into the market and goes from stock to being functional supply again and dumps into the system. That is, I think, where this stuff becomes a bearish overhang on the market. But I think a lot of people were talking about it like it was bearish when it was happening. And I actually think it's very opposite. And when it's happening, it's actually really bullish to see builds of oil and water because it's robbing current supply. And I think that's essentially another thing that went to kind of absorb a lot of that surplus. And again, was a direct result of Donald Trump. When you're looking, though, at demand, I think what's one of the things that's really surprising is that demand actually performed much better this year than I think anyone had expected. At the beginning of the year, we still had the hangover. We were still kind of processing the hangover of another year of contraction of demand in China, which anyone that balances global oil markets knows, like if China is in surplus or growing or declining, that's a pretty big weight around the entire global market. But China went from contracting at almost 500,000 barrels a day year on year at the beginning of the year to growing by that much by the end of the year again. I think that's another one of these things where the market overall still does not have a good read on exactly the future trajectory of Chinese demand, because for a long time it was very easy to say China's going to grow by 500,000 barrels a day this year. That was pretty standard. Now it's like, is it going to be flat? Is it going to shrink by 500,000 barrels a day? Is it going to grow by Those are big ranges. And even just the difference between a 500,000 barrel a day contraction and a 500,000 barrel a day growth is a 1 million barrel a day swing in global balances. And that has happened this year alone. And I think that's pretty remarkable. Some other countries that you would have expected that would have had a bigger kind of say or impulse in global demand, like India is the classic example, generally actually kind of underwhelming this year. It's been fine. It hasn't been tanking, but it's not growing at the pace that I think the market thinks or the kind of more bullish, optimistic vibe that say it will. Whereas you have seen, I think, more surprising demand from like North America. Now, a lot of this is NGLs, but still, on a barrel basis, you're still seeing a lot of positive surprises in areas you wouldn't expect it, and negative surprises in areas that you would have expected more growth.
Great, thank you. So let's focus on some of the more current themes that are happening. So obviously the first one is Venezuela. And could you just describe, briefly, what is the history of Venezuela's importance to the oil market, and what is the potential impact from Venezuela barrels coming back into the fold?
Well, so Venezuela is, as everyone has heard by now, Venezuela boasts the largest reserves in the global oil market of more than 300 billion barrels, which is larger than Saudi Arabia, larger than Canada, et cetera, et cetera. So lots of reserve there, even though those exact numbers are debated, I think reasonably debated. But in terms of where Venezuela is today, producing less than 1 million barrels a day of crude, from the stage of historically, Venezuela at one point was the world's largest exporter of crude oil into the global oil market. And you've seen essentially production fall from, let's say, a decade ago, from over 2.5 million barrels a day. At the beginning of the 1990s, end of the 1990s, you were over 3 million barrels a day, and an all-time peak in the early 70s of like 3.7 million barrels a day. So we're very, very low relative to where we've been. And as noted with the reserve comment, it's not a geology issue. It's not a capacity issue. It's entirely an above ground political, fiscal, kind of regulatory issue. And, Venezuela has had a long history of chasing its best human capital out of the country. We had massive waves, particularly in the early 2000s when Hugo Chavez purged a lot of the best engineers and kind of, geologists from PDVSA, the national oil company. Those individuals largely went to Colombia and Canada, where I'm calling in from Canada here. And those are two large, heavier oil resources, and that Venezuelan expertise was tremendously catalytic in kind of pushing those production basins forward, just as Venezuela began to kind of fail from the lack of their expertise. So the lack of human capital mixed with the fact that then later in the 2000s, Venezuela embarked on a very heavy nationalization spree and kind of expropriation spree. Many companies like Exxon and ConocoPhillips still have claims against the Venezuelan government because of this. So that basically you had, lack of human capital, expropriation, you scared away capital, and you forced all of these other companies to like deeply arduous and kind of heavy-handed regulatory strictures, like forced, a collaboration with PDVSA that needed to have a majority operating share. You had heavy taxes and fiscal terms, all this stuff. So it became very, very unattractive. At S&P Global, I love this stat. S&P Global has a list of the most attractive kind of fiscal and regulatory environments for oil and gas producers, and it's 111 countries long. And so like a year ago was the last with this update, and Venezuela was 111 out of 111. It was the least competitive jurisdiction on planet Earth, despite having some of theoretically the most attractive geology. So I think when we look at like what Donald Trump's doing now, there's obviously appetite in the abstract. There's obviously appetite and opportunity to take a massive capital-starved resource and pump a crap ton of capital and expertise into it. That is, obvious. I think the question is, in terms of going into an oil price downturn, going into a supply surplus where you have lots of other opportunities, particularly with many of the operators that we're talking about. Think, if you're talking about like ExxonMobil, that could theoretically go back in. Infamously, ExxonMobil CEO told Trump at his gathering that he viewed Venezuela as, quote, uninvestable, which Donald Trump did not like. But ExxonMobil has its kind of crown jewel asset now right next door in Guyana. And in the kind of ironic rub here, the removal of Nicolas Maduro actually removed and de-risked a kind of a key tail risk for those assets, in that Nicolas Maduro had been saber-rattling about kind of long-dead territorial claims against Guyana. So I think that's the issue. Is it's a factor of more opportunity cost, and these companies having a lot of opportunity elsewhere, and the fact that Donald Trump has actually not done anything to date thus far, aside removing the one man of Nicolas Maduro. he hasn't changed the rest of the regime. He hasn't done the things yet that would be required to make these companies kind of happy. So I think the companies that are happy and happy to participate in the current environment of what Donald Trump's doing in Venezuela, obviously Chevron, given that Chevron is still in the country and benefits hugely from any de-risking of Venezuela. So that's good for Chevron. And the other ones you've seen kind of a lot of appetite from are the global trading firms like Vitol and Trafigura, and that they have been more than happy to help the U.S. government essentially market these barrels on Caracas's behalf. So beyond that, though, you've seen a lot of kind of like raw, good job, president, but not a lot of like very clear realized appetite for putting the tens of billions of dollars and spending the decade that would be required to really turn around Venezuela's oil production.
Great. And, we'll sort of get to some of the factors that could hurt Venezuelan production over time. But, in a scenario where some of the near-term impediments are removed, what is the sort of upside over, say, the next 6 to 12 months for Venezuelan production?
Yeah, so I think one of the most important points in this question is what your baseline is, because I think if you're talking from October levels, which is let's say just before the blockade, Venezuela was exporting around 1 million barrels a day of crude. I think from that level, you're probably talking, let's say, over the next 18 months, you could probably get an extra 250,000 barrels a day out of Guyana. Probably that would be mostly Chevron production with added diluent imports and kind of a freer operational hand. I think you could probably get, let's say, 250,000 barrels a day more. But in terms of the incremental supply swing from now, much bigger than that, because right now there's almost zero Venezuelan oil actually hitting the oil market. You had this 30 to 50 million barrels that Donald Trump has claimed, what I'm calling his pirate booty. He's just kind of like, yes, they're giving us 50 million barrels. Okay. This is some of the stuff that Trafigura and Vitol have agreed to market on the White House's behalf. Those barrels, theoretically, are the first ones that are going to resume hitting the market. I think there's a couple questions in terms of how the oil market effect shakes out here. I think the big question is, are we just removing the blockade, or are we removing the sanctions more broadly? Because I think if you're just removing the blockade, that allows the flow to restart. So let's say you go from zero back to, like, let's say 1 million barrels a day. It probably will take a little bit longer than that because you've had wells shut in, you've had a bunch of operational issues now. But let's say you can kind of get back to that stage. I think that would mostly, if nothing else changed, that would mostly resume going to China. Now, the weird thing is that that's the other thing about this that I think is confused. A lot of people are saying this is part of this master plan for Trump to, remove or kind of strangle Chinese crude supply, which is fair in a way. But I think at the same time, then Trump at this White House gathering said China's free to purchase as much crude as they want from us. So sure, it might not be at discounted rates that they were getting before because of Trump's own sanctions, again, ironically here. But that could resume, but we haven't seen it resume yet because, again, the flow is still quite throttled. But if you remove sanctions as well, then all of a sudden you free that 1 million barrels a day to, say, hit the U.S. Gulf Coast in a much more real way, much more meaningful way than it has been over the past couple of months, where you've only had about 150,000 barrels a day of Chevron crude hitting the U.S. Gulf Coast. But the other thing I'll note here is that prior to the 2019 clampdown from Trump on PDVSA, this is when you really kind of got the wheels fell off of the Venezuelan industry. Prior to that, they were exporting around 1.5 million barrels, and only a third of that was going to the United States. So I think that's the other thing that's interesting here is that when people are talking about this, and when the White House has been talking about this, the implicit assumption is that if you freed Venezuelan crude, it would all go to the U.S. Gulf Coast. And that just isn't the case that we've seen historically. And the only reason it would do that is if the sanctions relief was structured in such a way that it could only go to the U.S. Gulf Coast. And I think that question of essentially, is it free to go to the U.S. or is it forced to go to the U.S. is going to drive essentially, I think, the difference in which crude benchmarks this hits hardest. If it goes back to the world, I think things just generally resume the way they were in October. But if you force the barrels on the U.S. Gulf Coast, you're going to see a heavier hit against competing kind of unsanctioned heavy barrel streams like Canadian, Western Canadian select barrels at Houston. And that's we have already seen relative from November, it was trading at, I think, $4 under WTI. And more recently, it's around $7.5 or $8 under WTI. So clearly there has been pressure on unsanctioned heavy crude streams in the US Gulf. But I think there's still this open question. I've been chatting with traders being like, and they're like, when do these barrels arrive? Does anyone know where this stuff is going? And the answer is like, no. So I think the market's still positioned cautiously on this. But so far, we don't really know. The only barrels we really know, so we've heard 50 million barrels. Just over 1 million barrels of those have actually been contracted to basically dump into tanks in Curacao. We don't really know what's happening with the rest of them. We're still having some barrels that are flowing from Chevron, but the rest of it is still this kind of open question.
Right. So that's a short term. And now sort of turning to the longer term, when
Yep.
you sort of read consensus opinions on what's, the biggest issues Venezuela faces with ramping up production, it usually goes by three broad categories. So the first one is their decrepit infrastructure and lack of power. The second one is the lack of legal structure and the historic issues companies like Conoco, Exxon, and others have had. And then the third one is, Venezuela's crude grade and then the current low prices. Out of those categories, which one do you think is the biggest impediment to ramp production over, say, 5 years' time?
I would say one of the first two. So either the infrastructure or the IOC reticence. I would say generally, and I would say that the issue to a degree is that the first two are a little bit related, which is that I'll say the infrastructure is the main impediment, but the reason the infrastructure is so dilapidated is because of the government and because of the governance in Caracas, which is also the reason that the companies are wary to get back in. So and we have seen some initial kind of lip service to amending and changing the hydrocarbon law. So the new president, Delcy, this is Maduro's vice president and oil minister, I think, importantly for this conversation. So she has proposed changes to the hydrocarbon law that undo some of those more onerous joint venture requirements, et cetera, that I mentioned earlier. More of these are now framed around essentially some of the structured deals that they have with Chevron that they made in 2020, kind of after those 2019 sanctions were in place. So I think that is a step in the right direction. But again, I think part of it too is that part of this is like what the law written down is, and part of this is just like a very basic kind of realized experience. And I think that people will need to see kind of the rubber hit the road of this new government, this post-Maduro regime, whether or not they are just talking the talk, or if they're actually like walking the walk. And that will mean respecting international contracts, servicing past debts. The debts are also a massive question, by the way, given that obviously they're a massive kind of weight around the neck of the new government. And again, in this White House soiree, Trump kind of implied to the CEO of ConocoPhillips that like no one's seeing any of the past money, and Conoco's has a claim against them for something like $12 billion. So that I think is also kind of an open question. Like if Trump is not forcing the new government to honor past debts, then yeah, that's also going to be a pretty big impediment for companies that are owed those debts to actually get back in. At one point, there was this thought that Trump would use those debts as the carrot, that like Conoco, as an example, would say, the White House would say, if you want to see a cent of that $12 billion, you've got to increase production by 500,000 barrels a day or whatever. And that would be some kind of like, inducement to get them back in. But again, those comments at the White House seem to not be going that direction.
Yeah, no, understood. And in a scenario where some of these impediments are removed, and we fast forward in 5 years' time, how high could Venezuela's oil production be? And could you give us a sense of the scale of capital investment that would be required to get there as well?
Yeah, and I think these are very fuzzy numbers, and I think anyone that you've seen kind of going out with these, the ranges we're talking about, people talk about, let's say to get back to where we were a decade ago. So let's say that's 2.5x from where we were pre-blockade. So let's say from 1 million barrels a day to 2.5 million barrels a day. That I think if everyone got in on the ground immediately, let's say no one had any hesitation, everyone just got to work, I think you could probably do that in 5 years, $50 billion. That's, I think, the kind of scale we're talking about. But I think more practically, it's probably going to be more like 5 to 10 years and $50 to $100 billion to get between 2 and 3 million barrels a day, depending on essentially how long it takes, what type of real reforms the Venezuelan government imposes. I think these are still these open questions. And I think at this stage, still too early to have any kind of confidence in this kind of longer term forward question. I think, again, we can be relatively confident in saying, let's say, get an extra 200,000 barrels a day in a year or two. But I'm far less confident in whether in those kind of 5 to 10 year numbers, because we need to see real movement from these companies. And the thing is, we're going to know those companies are moving years, half a decade before any actual barrels really come to the market. So we'll have lots of advance warning. And so far, we have not yet actually got any of that warning.
Right, understood. And then the other thing going on right now is, geopolitically at least, is what's happening in Iran. And we've seen oil markets react to that as well. Could you describe, what do you think the US administration's objective potentially is in Iran? Because it seems vague to me at least. And, is there a potential for Iranian barrels to come back onto the market from going from a sanctioned capacity to unsanctioned over time?
I mean, 3 months ago, I would have said there was a 0% chance that Trump would have, the US military Black Hawk down and kidnap the Ayatollah. But I would say it's above 0% now. So I would agree with you that the actual goals and objectives are deeply vague and contradictory. I think also we can probably acknowledge that, the Iranian state capacity is much greater than Venezuelan state capacity. Even though Venezuela has a large standing army on paper, this is not a country that has a lot of capabilities, as we've seen by the fact that they were able to literally nab the president of Venezuela without a single US casualty. I doubt you could be that successful in Iran in the same kind of context. So, particularly because Iran's been preparing for this for a very, very, very long time. In terms of what the goal is, I think that if Trump was given an opportunity and someone said, you can click this button and it's Iranian regime change, absolutely he would press the button. He's still trying to build his CV for his next kind of lark at the Nobel Peace Prize, of course. But I think that there is enough appreciation for the ways in which Iran can get much more complicated much more quickly than what we would see in Venezuela. I think there's, if you removed the Ayatollah, who would you be dealing with in government next? It's like, are you dealing directly with the IRGC? Whereas in Venezuela, there was a government, there was a vice president. And if you removed the president, you just had you could still deal with the same government. It's not as easy to do that in the Iranian experience. In terms of, I think, also the oil market implications here, I think it's funny that the oil market kind of barely winced, with what was going on in Venezuela. I think you had some real fundamental pressure from the blockade and everything else. But overall, the actual news of the day, you basically got a little pop, a sell-off, and then sideways trading for the next week. Meanwhile, you got a little tiny kind of ripple of some kind of, what's going to happen in Iran, and prices shot higher by $5 a barrel in the course of a week, driven by a deeply positive option skew, and essentially the same kind of I know you, Varesh, love this indicator in particular. But it's really interesting when you look at the chart of that option skew in crude over the past year. You see two things pop out like a sore thumb. You see June Iran and you see January Iran, which is just, I think, a sign of how the oil market interprets Iranian risk in a very different way. That I think we can reasonably talk about how the market has become numb to political risk, but the pure scale of the barrels we're talking about transiting the Strait of Hormuz, even though it's still, maybe we've gone from a 1% chance to a 3% chance of some kind of disruption, but even just, you're talking 30 million barrels, even slight changes in probability, I think can justify fairly exaggerated moves in options hedging and precautionary demand and everything else, which is what we saw in June as well. Even though there wasn't a real disruption, you saw, front running on trying to get prompt barrels, both of crude and of distillates, which again, very similar to what we've seen over the past kind of couple weeks as well. Going forward, I would say it seems like the regime is beginning to kind of reassert its control. We've seen the protests wind down after a truly horrific number of reported deaths and the kind of extremely violent crackdown by the regime. But I would say it feels at least like that kind of immediate pressure point has passed. But what's interesting is that the actual oil market itself hasn't moved on. You've still seen that option skew that's very, very high. And it looks like we're in that crisis, even though prompt prices and kind of flat prices have sold back off. So I think you've got your headline chasing algorithms. That's gone. I think we've moved on from that. But I think the real fundamental kind of real participants that were hedging this risk are still worried. And I think reasonably so, given that, yeah, we're still in a very volatile situation and there's still 30 million barrels a day is a lot of flow through the region. So even small changes can justify like big moves.
Yeah, I think you're right. The market's definitely still concerned, when you look at numerous metrics. So, that sort of covers what's happening at the moment from the geopolitical side. Let's take a look more broadly at 2026. What are the key factors you're watching to drive oil prices this year? Last year you were very accurate in where prices would go. What should we be watching this time around?
Okay, so in kind of a repeat of my view from last year, I think that, and honestly, if my true view went to plan last year, we would have been lower than 65. I think that was, a pretty cautious view at the time, thinking that OPEC wouldn't go through with as much of a hike as it actually did. If I had known the numbers in hindsight, I probably would have said it would have been lower, and I would have been wrong because of those kind of confounding variables of Chinese SPRs and US sanctions, et cetera, et cetera. I think at this stage, a lot of those same factors remain for 2026. The balances still look ugly. It looks like we're going into a period of oversupply. Yes, US supply will likely, what we need to see this year, we need to see Chinese demand stabilize in a positive way. We need to see US shale roll over, kind of at least plateau and roll over, but like it would be nice to see some like deeper, chunkier kind of declines, but although I'm not super confident we'll see them. But I think with all of that, even those factors, I still think we're in for a negative year for crude oil unless one of two things happens. Unless Trump goes completely insane and does something that, takes massive chunks of oil off the market or disrupts logistics like we've seen for another 6 to 8 months, which I wouldn't have said that was going to happen last year. And well, it did. So that, I think as a baseline, that's still a very real risk we could see. I think the other thing here that remains that the kind of what I thought was going to be the pivot point on policy in 2026 is what OPEC does. I think we still don't know. I mean, OPEC right now for Q1 has paused its increases. So it did 2.9 million barrels a day last year. It's still got, upwards of 3 million barrels a day it can release on paper this year that it at least, and it's according to its official comments, still intends to progress towards, but it's taking a pause for Q1. Because of demand weakness, seasonal, et cetera, et cetera, et cetera. The question of whether or not they actually resume that hiking in April, I think is going to be really, really interesting. I would say, based on what we're seeing, I don't think they should do that. But I would say as long as these disruptions continue, I think they're going to take the excuse and the kind of, the cover fire, if you will, to increase as much as they can, and then deal with the consequences on their side by potentially, I think this is what the real pivot point of 2026 will be if all this goes through, is I think that they'll have to recut again. I think that if we don't see sanctions disruptions increase and we don't see US shale roll off faster than I think anyone is expecting, we're still dealing with a pretty hefty surplus that would pull us down from, let's say, low 60s Brent right now, probably into the 50s, kind of low 50s at a minimum for Brent. And possibly, I think, likely lower than that unless OPEC does something. Now, I think the other thing to watch here is that we have official OPEC policy and production and kind of actual OPEC policy and production, which is itself, I think, more variable now than it used to be. We've seen the Saudis in particular. Like the Saudis can like take or an add to the market, 800,000 barrels a day pretty casually without, I think, the headline narrative picking it up. So they can shift around their exports and kind of manage, like stick handle on a kind of a higher frequency basis unilaterally. And I think that we have seen that many, many times over the past couple of years where they're like, we're not going to change official policy, or we're just going to ship slightly less this month or slightly more. And I think that has been something that they've been doing and something that is hard to parse because by the time that you have like real data on it, like the narrative kind of discussion points kind of pass, you're like, well, they just shipped less that month. But I also think that you've seen this around some of the other producers as well, of like the Emiratis pulling back, and I think in a way that I think was surprising as well, given how much they've been overproducing historically. So the other option to them not officially cutting is them doing nothing, but actually kind of secretly cutting. And I think that's the other thing that could happen here is that we would know it. I think we would, if it was to the scale we would need to balance the market, we could say that by the end of the year. But I don't think it's going to be immediately obvious when it's happening until a couple months later.
Right. And you talked about a low 50s potential oil price in the event of OPEC increasing production further. Where do you see their put? Because, this is obviously something people talk about in the market a lot. No one really knows. What is the sort of price level that, really ensures that their pain points hit and we start seeing this production curtailed once more?
It is a very good question. No one knows the answer, but my gut says it's sub 40 Brent. I think that given what they're dealing with, and I think they are wise enough to appreciate that we're going to need starkly lower prices to push some of these non-OPEC production basins into plateau and outright decline. And I think that if they cut again with Brent in the 50s, I think it's too much of a lifeline again. I think that they need to not only see prices lower, but they need to see prices low enough for long enough to see that kind of realized American flow in particular roll. And I think, and I don't think that they would begin to kind of panic and cut again with prices above 40s Brent. I think you probably sub 40, kind of that $30-ish barrel, I think is where they would begin to panic and cut again. But I think it's also an open question of how long. Because I think it's not just a pure price. I think it's a price times time thing, given that what they're really interested in is like their monthly earnings. And I think at that stage, you need to see a price sub 40 for probably a month or two. And I think that is when you would get them into a stage of cutting again. I think before that, you could see them announce more of an official pause, like an extension of this Q1 pause potentially. But I think you're going to need lower prices in order to get them to actually commit to an outright cut again.
Great. So you talked about US production briefly there. Could you expand more on how US production looks this year for the remainder of 2026, and then perhaps on the rest of non-OPEC plus supply?
Yeah, so I think US right now, the assumption is that we plateau through the beginning of this year and begin to turn negative basically through the second half of this year. I think in total, exit to exit, you're probably looking at somewhere in the ballpark of, like, we're not talking huge cuts yet, probably like 200,000 barrels a day, which is, it's enough, but I think it's not the kind of real pullback that I think the Saudis in particular need to see to feel comfortable raising production again, cutting production again and raising prices again. Outside of the United States, I think your other main growth centers right now, you've got Canada, Guyana, and Brazil are your kind of big ones. I get a little bit from Argentina as well. I think Guyana and Brazil, let's say Brazil is an example. I don't think Brazil is going to be super price dependent. It's going to be more operational and execution dependent. You have seen they've been producing really, really strongly for most of last year. There have been a couple hiccups and a couple bumps where they have, is Brazil pulling a Brazil again? Because anyone that has followed Brazil in production knows that they have tremendously underperformed their kind of growth expectations kind of consistently year after year after year. The last 2 years, they really did hit those growth expectations, which is why you've kind of seen the kind of big about face in the market view on Brazil. I think there's still always this possibility that they fall back, but I don't think it's going to be price because they're, the pre-salt break-evens, you're talking 35, 40 bucks a barrel. This is not stuff that's going to be super sensitive very quickly. Same goes for Guyana. We're talking kind of $35 break evens, very, very large projects with well-capitalized majors. Even if prices drop to $30, I don't think you'd see a material shift in the plan of the FPSO rollout for Guyana. Canada, I think, is an interesting story. I think that price could have an impact at the margin here. But I think more likely it's going to be a function of policy. And I think what we see right now with the main debate right now in Canada is whether or not we can get this additional, what they're calling the Northwest Coast oil pipeline built, which is a 1 million barrel a day bitumen pipeline to the West Coast, which has made some kind of grand bargain between Ottawa and Alberta in exchange for emissions reduction technologies, both pricing and CCUS investments. That I think is the near-term question of like, can we get that thing built? And then other kind of even nearer-term questions on egress expansion, which for anyone that follows Canada, egress is basically it. If we can get more egress, we'll fill it. And the other sources of egress expansion you expect there are going to be additional expansion of the Trans Mountain system, about 370,000 barrels a day extra you can get out of Trans Mountain likely. And then additionally, there's also a 400,000 barrel a day expansion potential on the Enbridge mainline. And the interesting thing there is going to be if we get this additional competition from Venezuela, which is, again, a heavy oil producer that's shipping into the U.S. Gulf Coast. Most of the U.S. market is now saturated with Canadian heavy, which means that any additional heavy we ship to the U.S. Gulf to the U.S. is likely going to end up being re-exported to the U.S. Gulf Coast. So again, I think the Venezuela story does make that less attractive on the margin. I think that could be something that if, let's say, you forced every Venezuelan barrel to that, back to the discussion we were having, if you forced all of that flow into the U.S. Gulf Coast, you had a more acute kind of impact on U.S. Gulf Coast WCS differentials, that could put a steeper kind of halt on Canadian growth than I've been expecting. But I still think that over the next year or two, our projects are such that they're slower moving and probably aren't that price sensitive on the margin. So I think really it's U.S. Like you need to see growth accelerate, U.S. supply pull back, or OPEC do something. Those are the main kind of faster moving variables. And beyond that, if we're talking like U.S. policy, it's what happens with sanctions. Like, do these oil and water builds unwind? How quickly do they unwind? And that's essentially the ball game.
Great. And then just a final word on demand before we sort of close off the oil chat. We're sort of into 2026 now. We're sort of well beyond the sort of timelines that the IEA thought global oil demand could plateau based on one of their scenarios. What does the outlook for demand look like over the next couple of years? And is there anything that could see demand plateau at a faster rate than we're sort of seeing?
In terms of the headline kind of global plateauing, it just at this stage feels almost entirely dependent on China. It just get back to that point of like no other country on earth has a reasonable growth range a year or two out of 1 million barrels a day. Like there's just no other country that has that kind of uncertainty bands around it. So I think that's going to be your main, like if China starts declining at 300,000 barrels a day from now until the end of the decade, it's going to be really, really hard for the rest of the global system to not begin to plateau by the end of the decade. But if they are flat to even growing modestly, we're gonna likely see demand grow straight through the 2030s. I don't think it's going to be gangbusters, and I think that there's a very reasonable debate around like, is there a massive difference between 100,000 barrels a day of growth and 100,000 barrel a day contraction? Not a lot. It's basically the same thing functionally. I think it says it's going to be very different in terms of sentiment and psychology, but in terms of the barrel math, it's pretty darn similar. So I think that what's more likely, I think, than a moment where we hit this like sudden peak and then everyone starts panicking is it's kind of more like the boiling frog situation that, rather than going from like 1 million barrels a day to contraction or flat to contraction, well, it's going to be 1 million barrels a day, then 900, then 800, then 700. And it's just going to gradually erode until, even 10 years ago, the common discussion was that demand grew 1.5% every year. Now the assumption is more like 1%. Eventually it's going to be 0.5%. That's where you, I think, begin to get into the situation where supply really needs to get hampered more durably if we're going to have another bull run, because inevitably the longer you have supply growth or that capacity even grow, it's going to be harder and harder to overcome on a demand basis. And I think that's probably what the next kind of decade or two is going to look like the oil market is this, debate, this race between supply and upstream production resources, which everyone always thinks are peaking, and always end up finding a different way to kind of come out the other side, and demand, which I think is just inevitably going to gradually slow. And I think the balance of products is going to switch much more from a crude heavy slate to increasingly an NGL heavy slate as everything goes towards petchem.
Great. So now we like to end our conversations with a few personal questions for all our guests. So I can see you're an avid reader from judging from your background. What are some of the books and TV shows you really enjoyed reading and viewing last year?
So here, actually, I've got one right here. I went back. So I'm a international security guy by background. That's why I went to school in my master's program for. And I went back and read this book called Command and Control, which is nuclear weapons, the Damascus accident, and the illusion of safety, which is specifically all about the history of nuclear weapons accidents, primarily from the United States, but more broadly across NATO, and specifically around the governance structure of the command and control system, which is essentially how those weapons are organized, managed, who decides to blow one up and who doesn't. How can you maintain control of your nuclear weapon system when after a first nuclear strike, likely 99% of the people that have any authority are all dead. So how does that system maintain itself? And I think what's really interesting, and the thing that kept coming back to me as I was reading this book over the last couple of weeks, was this is at the same time that the Pentagon was talking about integrating Grok or whatever, like AI systems and LLMs into these, Department of Defense and Pentagon systems. And the two things that just popped in my head automatically, like that and that story together, was one, I don't know if anyone's ever watched Battlestar Galactica, but one excellent TV show, and I will say that's a permanent recommendation. But there's a whole thing about there were no network systems on the ships, and they were paranoid about these AI systems basically destroying them. And yeah, basically time and time again through this command and control story, there were stories about individual humans that basically broke all the rules and prevented the world from ending. Your classic examples are, Stanislav, et cetera. These people that basically said all the rule books say the world is ending and I need to fire my missiles, but let's just wait a hot sec, because what's the worst that could happen if I don't end the world more, right? And I just don't know if I'm confident that AI systems are actually I don't know if I can trust that kind of, they're probably just going to follow rules. I think a little bit more rote. And I think that's going to be concerning. And then in terms of TV show, I definitely I binged Pluribus, I guess is how you pronounce it, which was just a deeply, deeply enjoyable sci-fi romp.
Great. And I know you do some teaching as well in your spare time. If for those people who are looking to learn more about the oil markets, where do you recommend they get started?
Well, first of all, I would definitely recommend they check out commoditycontext.com for all of my research. But I think more broadly, I think, there are so many good books and so many well-written books from, if anyone's getting in, you have to read The Prize by Dan Yergin. That's just an obvious starting point. But I think other books like Crude Volatility by Bob McNally and others that kind of go through, I think, more of the, less of just the pure historical and more of the kind of realized kind of market action of what all of this meant in a real way. I think it's just a really interesting kind of addition to all of the stuff you're going to be reading, which you should be reading in the sector. Read the Financial Times, read Reuters, read everyone else, because that's where most of this action is actually happening day to day.
Great. And then for those people who want to follow more about your work and follow your views, how can they do that?
You can follow me at Rory_Johnston on Twitter or X. I'm also on Blue Sky now, LinkedIn, and you can follow all of my work at commoditycontext.com.
Great. So thanks, Rory, for a wonderful conversation. We covered a lot of bases there, and hopefully have another chat soon.
Thank you so much for having me.
Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. Finally, sign up for our free newsletter at macrohive.com/free. We'll be back soon, so tune in then.